So breaking news came out last night, and Boston Globe said that starting this fall, all students will be required to go back to school in person, and that distance learning is not going to be permitted as the standard learning model. As a Zoom investor, you're probably wondering what this means. Just know, Zoom is not going away after the pandemic is over, but the stock price makes it look like the company is pretty much obsolete now that the pandemic is ending. And in today's video, I'm going to be talking about why patient investors in Zoom are going to be handsomely rewarded in the years to come. If you're new to my channel, my name is Larry, and I talk about all topics related to investing. If this content is helpful or useful to you, please like and subscribe because that really helps the channel. So we're going to be talking about 4 major areas related to Zoom. I'm going to give a quick introductory business model overview of Zoom, down to the detail that some people may not have covered here on YouTube. I'll also talk about what Zoom's business model actually is and why understanding it will yield you incredible profits in the years to come. Number 3, we're going to address all those concerns related to Microsoft Teams, Google Meets, entering the video conferencing market and taking market share, and what Zoom needs to do. And then finally, I'm going to talk about what I plan to do with my position given that the earnings report is coming up. So if you're considering Zoom as an investment or you're a Zoom holder, stay until the end because I'm going to walk you through what I'm going to be thinking about as it relates to this company. From a high-level overview, we all know that Zoom is all about video conferencing, but that really only scratches the surface of what the company really does. So let's look on their website and you can see that video conferencing, they offer it in several tiers. One for free users, others for paid hosts. Most investors, when they think about Zoom, they think about the company operating from this pendulum where if people are working from home, everyone's going to subscribe to their services. And once people start returning to the office, people are going to just start canceling their subscription. While portions of that theory could be true, that won't really be the main driver of the company's performance in the future. Now let's take a look at why. And before I forget, I wanted to tell you that I'm a Seeking Alpha contributor, so if you want to see my written research on companies that I cover in the social media space, make sure to follow my account in the description below. And when I produce my research on Zoom, I'll see you in my comments section. If we look at their annual report, you're going to see they have 3 primary metrics to really follow from a true investing perspective. One is the number of customers that they have where these customers have fewer than 10 employees. That's typically the general marketplace where people are purchasing the $15 version of Zoom, use it for video conferencing. But the other areas of Zoom's business model is where they really make their money. The other 2 segments include the customers that have over 10 employees in their organization, and the third segment is their enterprise solutions, where customers spend more than $100,000 a year on Zoom. Across these 3 segments, they made $880 million in the latest quarter. And this year, they're projected to make over $3 billion in sales. Now, when we think about the future of Zoom's business model, most people, they're concerned about whether Zoom's revenue is going to take a hit because of people canceling their subscriptions now that the pandemic is over. Here's the truth. That segment that you see where Zoom made up 36% of their revenue from customers that had fewer than 10 employees, over time, that reliance on individual users is going to shrink as they increase the number of products and services that they sell to enterprise companies. As a result, Zoom's business model will get gradually less concentrated in the ordinary type of everyday user. And in fact, they use the ordinary everyday user as a way to promote its simplistic product, which in my opinion is one of the best products on the market. Zoom's video conferencing platform is really only one of its products. They also provide Zoom webinars, Zoom phones, and also Zoom events. And all of these segments are quickly growing. In fact, Zoom phone was such a rapidly growing segment in the company that investors are now eyeing how that service is going to potentially be a major contributor to Zoom's overall revenue to come. So as you can see, Zoom's video conferencing software is not the only source of revenue that the company relies on. Now let's talk about the future potential business model of Zoom. So we know that Zoom does video conferencing. We know that they do webinars. They also have Zoom phone, and they're also having Zoom events, which will allow content creators to create an audience and sell their products and services to a wider audience in the future. But when I think about Zoom's massive user base, Zoom is secretly a social media company with such an incredible large number of contacts. If Zoom wanted to create its own social network, there is already incredible familiarity around the company's branding and service quality. In addition, if Zoom wanted to become a cloud storage provider, I see that as also another possibility for the future direction of the company. Now, the reason I think that is if we look on my Zoom dashboard and we log in, and as a user, you can see that there's this feature known as Zoom channels. And when we think about channels, if any of you are familiar with Discord, you would know that channels is a way to communicate your message broadly to a wider audience. And the fact that Zoom actually has something called Zoom channels means that they're considering broadening out their service so that it becomes not just a video conferencing provider, but overall a communications platform. If Zoom were to enter the social media space or the cloud storage space, that would open up their doors to becoming a digital advertising company or a future subscription-based model for cloud storage. These developments for advanced investors, you would understand then that that would support the premium valuation that the stock market has given Zoom, and it would allow the company to diversify its revenue beyond video conferencing. Now let's talk about the elephant in the room: churn and competition. Churn is this concept that when a user subscribes to a service, pays for it for a period of time, and later drops it, what that does is it creates problems for the company's revenue and sales growth because people are dropping off their subscription, and therefore the company would continue to need to subscribe new people to their service to keep growing their company. Here is the truth. Zoom doesn't actually need new users to grow. You heard it here first. Zoom does not need new users to grow revenue. And you're like, how's that possible? Well, we look at a metric known as net dollar expansion rate. Most people, when they look at subscription services, they look at the concept of what's monthly recurring revenue. And while that metric is fine, it doesn't capture the upselling opportunity at Zoom. So the net dollar expansion rate is the real metric you want to look at. And I'm going to show you the formula here, where it considers the upgrades, meaning the upsells that Zoom offers, along with the downgrades that Zoom customers might choose, and the potential churn, the subscribers dropping off their service. And this metric allows you to look at the company's ability to grow despite not having new users. So any figure above 100% is healthy. Some of the top cloud companies in the market today have a net dollar expansion rate of about 120%. But here's the gold nugget. Zoom, for the last 11 quarters, has produced a net dollar expansion rate of 130%. So what that means is that Zoom doesn't need new users in order to grow their revenue. That is a very important metric to follow, because that means that the churn concern is not as severe as people might think. So then you're probably wondering, well, what about competition? There's Microsoft Teams, there's Google Meets. In fact, the latest competitive figures are pretty scary for Zoom investors. You can see here that at the height of the pandemic, Zoom commanded 300 million active users. Microsoft Teams lately has now 140 million active users, and Google Meets has about 100 million daily active users. So Microsoft and Google are quickly catching up to Zoom. Does that mean that Zoom is in grave danger of being obsolete, or is Zoom in grave danger of having their users go to another platform? I'd say not. Because in a latest survey, 42% of all Microsoft Teams users reported that they continue to use Zoom. In addition, when we think about the total addressable market in video conferencing and in communication platform providers, the truth is there is more than enough space for one big provider. So there is the great potential that Google, Microsoft, and Zoom can coexist in a growing space over time, because their services are not exactly the same. Zoom provides an all-in-one communications platform that Microsoft or Google might not necessarily provide. And we know that their products are not exactly overlapping, because Microsoft at one point, before Zoom's IPO, wanted to purchase the company for a handsome sum. Now for Zoom investors, their latest earnings report is coming out in just a couple days. And if you believe in the long-term positioning of the company, I'm telling you right now, there is absolutely going to be volatility in the stock price after. The company stock price could jump up or down 15% or even more, because investors are going to be closely assessing whether the company can keep its growth rates now that the pandemic is in the rear mirror. But if you think about how Zoom is positioned, and you can think about where the company can expand to, the new markets that it can attack, I believe that the current valuation is one where the company can grow into and eventually even support a higher valuation as well. What I'm doing with the company is this. I currently hold 100 shares, and I purchased Zoom when it was around $290 during the past couple months, when there was that great rotation between growth to value. And even if even if the next earnings report brings the company back down to my purchase price, I plan to hold. And if the stock goes way below my purchase price, I probably will add lightly onto my position, because I really do like how Zoom is positioned for the future. So while this stock is not for everybody, if you have one, a higher risk tolerance, and two, a longer time frame, I believe that Zoom in a couple of years will not only be a video conferencing platform, but also indirectly a social media business, or even a cloud storage platform. All of these factors combined is going to make Zoom a fast-growing tech company in the space in the years to come. Now, in the coming days, I'm going to be producing a detailed research report on Seeking Alpha, because I'm now a contributor on the space. And if you want to read and understand how I come to these assumptions and come to these conclusions, make sure that you follow my Seeking Alpha account in the description below. And with that said, if you enjoyed this, please like and subscribe, because that really helps the channel and helps me give you my latest and greatest research insights. Until then, I will see you in my next video.